If you're keeping over this amount of money in your bank accounts, you could be making a huge mistake. I know so many people that have too much money in their bank accounts and they think that they are doing well financially. And I get it, it feels safe and responsible. But the truth is that if you're stacking too much cash, it can actually be slowing down your progress on your financial goals. According to a CNBC article, 82% of Americans don't keep their cash in a high-yield savings account, and 57% just keep it in a traditional savings account, earning little interest. Cash management is one of those rarely talked about skills that you should have in personal finance. And today I want to share with you why having too much cash in your bank account could be one of the most costliest mistakes that you could be making with your money. Also, at the end of the video, I will tell you exactly what you should be doing with your cash instead. So the first reason why having too much cash is a huge problem is that you will spend more. So think about it this way. If you have $30,000 in your checking account and you spend roughly $2,500 a month in that account, the extra money that sits in there, you'll just be tempted to spend more of it. If you're out shopping and you see something that you like a nice pair of shoes, a designer bag, or even just a phone case, you might not actually need that item, but you might splurge on it because you know that you have $30,000 in your bank account. And this just isn't a universal feeling. There was actually a study conducted on this exact phenomenon back in 2010. The paper is called Spending on a Fly, and the researchers analyzed 400 shoppers from 2 grocery stores in the United States. And they found that there was a pattern where people with a higher budget certainty and financial cushion usually spent more freely. So what this means is that when people had higher account balances, they perceived that they had more room to spend whenever they were shopping for groceries, and they typically ended up overspending. So if you're the type of person who likes to keep a lot of cash in their bank account and you run your entire life from that one account, it can be really dangerous. If you have your emergency fund, your house fund, and maybe you're also saving to buy a new car and you're just lumping all of that money together in one account, the problem you actually might run into is that your balance may trick you into thinking that you can spend more than you should. But in reality, you're just dipping into your emergency fund reserves. An easy solution here is just to automate some of your paycheck into different types of buckets. So you should be able to set this up with your employer, or you can even do it within your online banking. Whenever you do get paid, perhaps you move a portion of that paycheck into an investment account or an emergency fund or a different types of savings account for whatever your short-term goal might be. The second reason you don't want too much cash is that your cash is not working for you. This is actually a problem I ran into in my early 20s. I just kept all my money in a checking account and I didn't realize that there was this thing called investing. When you keep your money in a traditional bank account that pays you, say, a 0.1% interest rate, it means that your cash, number one, is not working for you, and number two, you are incurring a huge opportunity cost because of that cash. It's just not doing anything. So I have a personal story about this. I have a friend who's an amazing YouTuber here on the platform. I will not name him, but he makes a really great income. I think he makes around $20,000 a month and sometimes even more. He confided in me about a year and a half ago that he's afraid to invest. He just can't get over the mental hurdle of investing. So he was just stacking up all this cash in his bank account. Oddly enough, he actually watches all of our videos on this channel. And even with all the data and all the facts about investing and how it's going to grow his wealth over time, he was still afraid to put his money into the market. So on the screen right now, I'm going to pop up our actual conversation that we had from October 8th, 2024, when I asked him if he had invested some of his money yet. You can see that he was still waiting as of October 9th, 2024, and he thought that the market had topped at this time. At that time, he had $80,000 in cash waiting to invest. And he actually never ended up investing, which is just a huge shame because if we take a look at the S&P 500 on October 9th, 2024, it was trading for $5,792. And now about a year later, it's at $6,700. That's about a 15.6% gain that he missed out on because he was afraid to put his money to work. And so on an $80,000 sum of money, that's $12,480. As of filming right now, that was forgone. Now for this person in particular, because he can't get over the mental hurdle of investing, I'm just going to tell you that he actually ended up signing on with a money manager about 3 months ago, just so that he didn't have to deal with the fact of not knowing when to invest. He is now paying a 1% standard fee to have a financial advisor that invests for him. But for him, I think this is the only solution because otherwise, if he was doing it himself, that money would never get invested. The wealthy understand that idle cash just loses money to inflation, which we will talk about quite shortly. But they are always asking themselves, how can my $1 right here generate more dollars in the future? Point number 3 today is that people think that they need more excess cash than they do. And I actually call this the excess cash illusion. So it's no surprise that people like to hoard money. I mean, typically for safety reasons, but people just like to have more cash, just like my friend who's earning way too much money as a YouTuber and not investing it. I have some other friends who have tens of thousands of dollars in cash, and some of them actually keep that physical cash under their mattress. I see this a lot with immigrant families as well. There's a lack of trust in the financial system, but I think having this excess cash, perhaps if it's under your mattress, is hurting your ability to compound your wealth. Now, for reference, I think an emergency fund should really only be comprised of a few factors. Number one, it should cover your rent or your housing payment. I think it should also cover your groceries, like the basic essential groceries out there, not like the Whole Foods or the Alwyns of the world. You also want to add any outstanding utility bills you might have and any outstanding debt payments that you have to make on a monthly basis. Once you add up all of these payments, this is the single month of expenses that you should base your emergency fund off of. So usually you want to have between 3 to 6 months of this number saved up. This is the money that you would need in case you ever lost your job or a real emergency comes up. This fund allows you to keep your life going until you find another source of income. Any cash that you are hoarding beyond this 3 to 6 month range of emergency funds is really not that efficient and should either be deployed for investing in future wealth building, or it should be serving a purpose like it has a specific savings goal in mind. The most consistent advice that I can give you is that if you need the money within 5 years, it should not be invested because you could lose it if you invest it. So instead, you should just keep that money liquid in a bank account. When it comes to keeping liquid funds, whether that's an emergency fund or the money that you have saved for a specific goal, you want to make sure you're earning the highest rate that it can be getting, and that's usually in a high-yield savings account. Currently, high-yield accounts are paying around 3.5% as of filming right now. So, on a bank balance of say $30,000, that's an extra $1,050 per year that you could be getting just for keeping it in there. And high-yield accounts are still liquid enough and you can still access your money at any time. I personally keep any excess funds that I have in a high yield account, and I will also link below a tool to some of my favorite high yield accounts in case you are looking for an option. Now, you could also consider CDs like certificate of deposits or treasury bills over high yield accounts for slightly better rates, but I still think the lowest hanging fruit is simply using a high yield account because it's the most liquid. The fourth reason why having too much cash is a mistake is that it loses value to inflation. If we take a look at the Fred M1 money supply, that includes bills, checks, basic savings accounts, and other assets that can be converted into cash quickly. The supply of money has been rapidly expanding since 2020, which is lowering the purchasing power of our existing dollars. This can also be referred to as inflation, and every year the purchasing power of your money decreases. With inflation averaging 3 to 4% annually as of recent, and we've seen it even spike to 8 to 9% in recent years, your 10K, 20K, or even 50K in excess cash that might be sitting in a bank loses value every single day. So let me give you an example. If you have $50,000 in your savings account today and inflation averages just 3% per year, well, in 10 years, that same $50,000 will only buy what about $37,000 buys today. And you might have seen this in your real life in the past 5 to 6 years. I'm going to put up on the screen some of the prices from 2019 to now and how they've changed. A Chipotle burrito back then was $8.50, and today that's closer to $12. The median price of a new car was $38,000, and now it is $48,000 as of 2025. And I just wanted to highlight a gallon of gas. While this does fluctuate from time to time, the average still went from around $2.50 to $3.20 today. So imagine your bank account during this time stayed the same. That's probably fine. But what you can buy is completely different now. $50,000 in 2019 could have bought you 5,882 Chipotle burritos, but now it can only buy you 4,166 burritos. That's 1,700 plus fewer burritos. And for what? Inflation? I have a lot of ideas on what I could do with 1,700 burritos. I can make a whole Lego house out of them. I could toss them like footballs to everybody in the street. And I could even juggle them. My point is that you can now afford less with the same amount of money. And so therefore, we actually need to make sure that we're at least beating out inflation when it comes to our cash for the sake of the Chipotle burrito. Now, you don't have to just buy stocks in order to beat inflation. There are tons of other assets that you can own. In fact, I made a whole video about 5 assets that you could own instead of cash, and I will link to that video down below and probably at the end of this video. For example, you could own real estate, you could own commodities, you could own collectibles, or perhaps even I-bonds. Real estate can be a pretty good hedge against inflation because if you own a tangible piece of land or property, that property will always be there as long as there are no natural disasters or anything like that. As we print more money, that means there will be more dollars chasing the same amount of goods out there. And land is typically a fixed supply type of asset, so that could be a benefit if you own land. The wealthy don't like to keep too much excess cash because cash is kind of like a depreciating asset. It is losing its value over time. I know it's kind of hard to think of it that way, but it's almost like driving a car. A car loses value over time. So we want to make sure that if we do have cash now, we're at least using it to some degree to generate more cash into the future. And the next reason why having too much cash is a mistake is that oftentimes it fools you into thinking that you are actually being good with money. The Dunning-Kruger effect is a cognitive bias where people with low ability in a particular area, they tend to overestimate their skills. This is often because they don't know what they don't know, and they aren't sure how to accurately gauge their performance. And oftentimes the victims of the Dunning-Kruger effect will blame others for their own fallacies. The funny thing about this effect is that it's very hard to overcome because someone who is incompetent at something, it keeps them from understanding how bad they really are. So you'll see this play out in real life all the time. People will often think perhaps they're the next Warren Buffett because they've made some money day trading, or perhaps they've made some money on a real estate transaction and now they think they are, Grant Cardone or something like that. In terms of having too much cash, if you have $60,000 saved up, you could be thinking that you're doing better than most Americans. And that may be true, but you're doing better than them at saving. You actually might be failing at the real goal, which is wealth building. Having a lot of cash might make you feel smart, but actually being smart with money often means that you have relatively little cash because it's all deployed strategically. Remember that the thing you should be keeping track of isn't your bank account balance, it's your net worth and your asset number. All right, so now that we know some of the reasons why having cash is a mistake, what is the actual right amount to have in your bank account? I personally think that the right amount of cash to have in your accounts is the combination of your emergency fund plus any short-term savings goals that you might have. So let's say you have a 6-month emergency fund of $25,000 and that you're also saving towards a house and you have $20,000 saved up for that. Then the right amount for you might be $45,000 in that case. And hopefully that's all being held within a high yield account, at least earning you between 3 to 4% in interest. I think one of the most practical things that you can do today is to calculate exactly how much of an emergency fund you actually need, and then create a separate bank account for your emergency fund as well as your short-term savings goals. And my hope is that the money that you have for these funds is in a completely different account from your main checking account where you get your paycheck. I'd rather see you have an automatic transfer from your main checking account where you get your paycheck, and perhaps part of your paycheck goes to your emergency fund, or perhaps the fund to buy your house, buy a car, or perhaps buy more Chipotle burritos. And then the last thing that I would do is also set up a calendar reminder every 3 months to review your accounts. This will make sure that you are keeping all of your steps in check. You want to make sure your emergency fund is not growing too large, and you want to move any excess cash that you have into investments. Or if you get a raise, you want to increase the amount of automatic contributions to your short-term savings goals or your future investment goals. I hope that you found this video helpful. And if you'd like to check out my video on the 5 assets that I think you can invest in besides cash, you want to check out this video right here. If you are looking for a high-yield savings account, I will leave a link to those down in the description box below. And I will see you guys in the next video. Thank you for being here once again. Peace.